today we're going to finish up chapter 3, or at least get as close as possible. I think we'll be pretty much finished. We're going to do a lot of questions, or examples, so bear in mind that. We talked about adjustments, adjusting entries, right?
Yeah.
We talked about cash basis, accrual basis account. Here, when we're doing accrual basis, we are recording revenue when it's legally owed to us. We are recording expenses when we legally owe them. And under accrual basis accounting, we have certain adjustments we need to make. Okay. Now I'm going to go into, today what we're going to do, I'm going to go into some examples, right, of those adjustments, the major adjustments that you're going to see. And I'm going to show you how we work those into the trial balance, okay? Everybody with me so far? So these were the 4 major adjustments we talked about. And this is a framework for adjustments, right? So there's a 3-step process in which we make adjustments. First, we're going to determine what the current balance equals, right? So when we're working these problems, we're going to look at the current balance. And then we're going to determine what the current balance should equal. And then the final part of that process, we're going to record an adjusting entry to get us from step 1 to step 2. So we're going to determine what the current balance is. We're going to figure out what we want it to be. Not what we want it to be, what it should be. Want sounds like cowboy accounting. There's a CEO who's going to watch this one day, and they're going to hear this, and they're going to laugh that I said that.
Mm-hmm.
So it's an inside joke I just threw in. And then, the CFO too. And record an adjusting entry to get from step 1 to step 2. So let's look at prepaid, right? So prepaid insurance, we just did an example of this, but I want to show it to you. So if we had prepaid insurance, right, our first entry, say same scenario that we just looked at. Fast forward paid $2,400 to cover your insurance for 24 months. That began on December 1st, 2017. Scott recorded the expenditure as a prepaid. So we're going to debit the prepaid insurance. Prepaid insurance is what type of account, scholars? Asset. Fantastic. It is an asset. So that initial entry, we're just going to debit the prepaid insurance. Everyone with me? Now, once we use a month of insurance, so step 1, our current prepaid balance is $2,400. After we've used 1 month, we know that we should expense 1 month off of the insurance. Is everyone with me? Let's say we bought the insurance December 1st. Now it's December 31st. We need to expense off 1 month. 1 month of insurance is $100. So we know that currently the prepaid insurance balance is $2,400. What it should look like is $2,300. Everyone with me? This is what it is. This is what it should look like. How do we get to that point? We need to adjust the account by $100. Are you with me? Mm-hmm. How do we get to that point? We debit the insurance expense by $100, and we credit the prepaid insurance account by $100. So if I go back one more slide. it doesn't show it in a, yeah, boom. We're gonna debit the insurance expense $100, credit prepaid insurance. That way we can bring the account down to $2,300, where it needs to be. And debit the insurance expense account. Everyone with me so far? All right, let's look at another adjustment. Let's look at supplies. Fast forward, purchased $9,720 worth of supplies in December. Right? Some of those supplies were used during December, right? A physical count shows that used supplies equal $8,670. So what is happening is, currently flash forward supply count is a debit of $9,720. What they want is the account to be $8,670. Everybody with me? That's in. They did an ending physical count, it's 8,670. It started as 9,720. So what do we do? There's an equation for this. You guys need to write it down. We'll deal with this equation quite a bit in this class. It's beginning supplies, beginning inventory, beginning whatever, plus purchases, minus your ending, equals what you used. Beginning plus purchases minus ending equals what you used. And we're going to change this equation around quite a bit throughout the course. We're going to move this equation around. Sometimes we won't know what the ending is, but we'll know beginning, purchases, and used. Sometimes we won't know the purchases, but we'll know beginning, ending, and used. Everyone with me? So there'll be some algebra here with this. But in this case, it's pretty straightforward. Because this company began in this period, they started out with 0 supplies. They purchased $9,720 worth of supplies. They ended with $8,670 worth of supplies. So they had to have used $1,050 worth of supplies. Everyone with me? That $1,050 needs to be expensed off the books. So how are we going to adjust the supplies account? We're going to debit the supplies expense and credit the supplies account. Supplies account is what type of account?
Asset.
So if we have it as a credit, it means that the asset did what? Increase or decrease?
Decrease.
Decreased. There we go. We decreased the account. Everyone with me? This is how we do supplies. So at the end of every period, right, they're going to do an inventory count, and they'll come with the inventory count. You'll take the beginning number plus whatever you purchase minus whatever that inventory count is. That'll be your ending to get what you've used, and you're going to debit the expense and credit the supplies for whatever you've used for that period. This is if you're keeping inventory. These are for large companies too. If you're working for a smaller company, normally when you buy supplies, you normally just expense them off. Like when you run to the store and buy paper or pens, you just expense them because the thought process is you'll use them within a year. Everyone with me? All right, depreciation. Depreciation is a calculation of usage of an asset. Depreciation, an estimated calculation of usage of an asset, right? Instead of expensing it off the cost of an asset, the year it was purchased, we expense it over a certain time period. We call that depreciation. We have a chapter on depreciation, I believe it's 6. Many of you have learned your principles of depreciation through your car dealer. Please don't come into Chapter 6 with notions from your car dealer on how to do depreciation. That will set you back on your third exam. You're up there writing, you're like, this is how straight line works. Who told you? Oh man, the Honda dealer, the guy who sold me the car, he told me how it worked out. Now, for this class and for the practice right now, before we get into actually how you do depreciation, as I said, it's a couple of classes from now. What we're going to do is I'm going to give you what depreciation is. So, okay. But how we're going to calculate it is what we call straight line depreciation. Straight line is you take the asset's value minus what we call the salvage value. I'll explain what the salvage value is in a later chapter, divided by useful life. All of these numbers will be given to you. That's going to be pure gold. Are you ready? So, in this case, right, fast forward purchase equipment for $26,000, right? The equipment has 5-year useful life and has an $8,000 salvage value. So if you took the $26,000 minus the $8,000, you get $18,000 divided by 5-year useful life or 60 months, and you get $300 a month. And so what will happen with the depreciation is, well, what did I do here? 62,000 minus 2,000. Oh, it's a different calculation. So if you take 62,000 minus 2,000, I don't know why they put that extra slide in. Minus 2, you get 60,000. Divided by 5, you get $12,000 a year. So therefore, every year, we'll expense off $12,000, and we're going to credit an account, and I'm going to introduce you to a new set of accounts. This account is called accumulated depreciation. So we're going to debit depreciation expense, credit an account called accumulated depreciation. And what accumulated depreciation is what we call a contra asset account. Go back one slide and show you that. Contra asset account. Meaning it's in the asset section of the balance sheet, but it runs contra or negative to the other assets. So in this case, it runs negative to equipment. So we have equipment for $62,000 minus accumulated depreciation for $12,000. So now equipment is on the books for $50,000. Now, is that necessarily the value of the equipment? No. It's just an estimation. Right? We basically said we're going to use the equipment every year for the same amount. Is that necessarily so? No. Sometimes you take equipment and you store it for a little while. That makes sense? You might have bought a crane, but you bought it in December and there wasn't any construction going on. So it might sit until until June, I'm sorry, when it gets warmer. That has no bearing on the depreciation. That makes sense? All right. Unearned revenues. Unearned revenues is when cash is received in advance of products or services being received. Cash is received prior to products or services. So, fast forward, client paid 60-day fee in advance covering the period of December 27th to February 24th. So when they did that, we're gonna debit the cash, credit the unearned revenue account. Now, fast forward, earns the payment, right? It's past its time. December 31st, 5 days service. So what happens here is on December 31st, 5 days needs to be included. So think of this as a timeline. That's what they're doing. You have a timeline. And this service starts from December 27th and it goes to February 24th. And what they're trying to get at here is that the end of the year ends 12/31. So they're trying to calculate how much revenue did you earn in, let's say, 2018. Let's say this is 2018. Everyone with me? So these 5 days of revenue need to be put on the books for 2018. So how do we do this? We need to make an adjusting entry reducing the liability by $250 or for those 5 days, right? How does that occur? How does that happen? Well, we're going to debit our unearned revenue and credit our revenue account. It'll look like this. Debit unearned consulting revenue and credit consulting revenue for the $250. That's just to make sure that revenue is recognized for those 5 days. Everyone with me? Let's do another one. Accrued expenses, right? So this is another timing issue, and this is about wages, right? So individuals can be working, right? So December 13th, they last got paid on December 25th. The next pay date is January 1st. But in between this pay date, these 5 days, between December 25th and December 31st, need to be put in the 2013 expenses on the books for 2013. That makes sense? Because they worked in 2013, they need to be expensed in 2013. So what do? Well, let's say the workers work for $70 a day, right? Or for 5 days, you take 5 times 7, that's $350 for those 5 days. And we need to expense that. So what we'll do, we will expense the salaries for those 5 days. Well, let's say 3. Wednesday is, for 5 days they would get paid, but it's only 3 days that we're working with. So the 3 days, we're going to debit salaries, expense, and credit the payable for those 3 days. Now in the future, now it's let's say it's January 9th, and they're going to pay them. Here's your 3 days. The rest of your salary will get expensed. And then on January 9th, when they pay them for all 10 days, it's $700. Does that make sense? If it doesn't, ask a question now. I'm going to stop on that slide. We only have one more question. Okay, so we only had revenue to go. And then I was going to show you the slides. So I've pretty much finished adjusting entry.